All right, let's get started. Good morning and welcome to today's Thursday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play, and today I'm going to be giving you my thoughts and analysis on the current markets. So just so everyone is aware, I wasn't available earlier this week, which is why I pushed this webinar to Thursday or to today. But moving forward, it will still be on Tuesdays. So just because it's on Thursday today doesn't mean it's changing in the long run. So the next market outlook will still be next Tuesday. Okay, so our disclaimer: the types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video was not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, starting off with the major equity indices as usual, highlighting some key levels. And once again, we are seeing the S&P flirt with that major area of resistance near 420. So we will be taking a closer look at the price action at that key area. From there, moving on to fixed income and commodities, we'll take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the overall market. We'll take a look at some subsectors of interest that I have for you today, and we'll end today's webinar on some bullish and bearish market observations. When it comes to the subsectors and the market observations, they're really all from last week. We're just going to be giving you an update as to how those ideas are going. The reason I didn't really want to have any new ideas yet was because of non-farm payrolls on Friday, which will be a high volatility event. And I'd like to sit on my hands until then. All right, so starting off here with the S&P 500, and we can see the SPY at the key area at around 418 to 420. This is the 23.6 fib level on the weekly time frame. Now, price overall is still on a bullish trend defined by higher highs and higher lows. Yes, we had a long consolidation period for just over a month with price unable to break above the 418 level, but there were some signs that that breakout was imminent. We saw, initially what was looking like a breakout that immediately reversed lower back down to 410. And then again, another move higher. Did it temporarily break above resistance, but price back down below that level and opening up a little bit higher this morning. So overall, still some consolidation at this area of resistance. But a big uncertainty was the whole debt ceiling discussion. When it comes to the debt ceiling, it is going to be increased. Monday is actually the deadline for it, but a bill has been passed onto the Senate, and that it shouldn't really be a problem. And overall, I think the debt ceiling is much ado about nothing. It's really more of a political exercise than a market exercise, because you always have the one opposing party using it as leverage over the other. So that's what we saw this time as well, with the Republicans wanting maybe more spending concessions from Democrats, and that was a leveraging tool. But there's no real risk about it, about the US not lifting the debt ceiling, because it will cause, if they didn't, it will cause a default, and that has catastrophic global and of course domestic implications. So for that reason, it's a very small thing to do to really avoid a catastrophic system collapse, really. So that was never really in doubt. However, it did mean there was a bit of a ceiling for equities and it didn't really allow equities to continue higher until the debt ceiling was sorted. Now that the debt ceiling is sorted, the next focus is Friday's non-farm payrolls number, which should give an indication as to how quickly the Fed can start cutting down interest rates, and will give an indication as to how labor inflation is doing as well. So we have an area of resistance at 418. Price, I do expect, will eventually break this much sooner rather than later. And I am looking for continuation higher. We are seeing buyers pressurizing this zone. Now, the next key level on the weekly time frame is actually 430, so not too far from where price currently is. Previous area of support on the weekly time frame also turned resistance last year. I still view this as a more minor level. If price breaks above this 420 area, that's a significant breakout, and I do expect over the next few months for a rally potentially back to the 450 being the upside target here for the S&P, especially when you consider, interest rate cuts are going to be a natural tailwind for equities. So bias still quite bullish for the S&P, but like the last few months, I think patience is definitely required. Okay, moving on to the NASDAQ 100 using the QQQ ETF, and we are seeing very bullish price action, and no surprise here. So first thing I want to point out is momentum is above 200. This is an overbought condition, and momentum has been overbought, or price has been overbought for the last few days, which means that there's a higher probability of a move lower to recover from that overbought condition. But this does not mean a change in trend. Overall, the trend is still very much bullish. A big reason for the recent move higher was the AI-driven rally that we've experienced over the last couple of weeks. The NASDAQ 100 is a lot more exposed to growth stocks and to technology stocks that have more exposure towards AI compared to the S&P 500, which is why we are seeing such a strong rally here for the NASDAQ 100. Now, that being said, on the weekly time frame, we can see prices at a key area at around 350. It actually reacted to at that 350 level over the last couple of days. Previous area of support potentially turning out to be minor resistance. I wouldn't view this as a major level, but I do expect a bit of a pullback for the NASDAQ 100, and that might provide a much better buying opportunity for a move higher. But again, bias here still remains quite bullish. There's a lot of momentum. Weekly momentum as well, just reaching the 200 area. So we may see a bit more of a pullback sooner rather than later. But again, this 350 area, I do expect that to be broken. And then from there, we have 370 and potentially even the 400s, which is all-time highs for the NASDAQ 100. But overall, quite a positive outlook here for the Qs. Okay, back to IWM, which is the Russell 2000 ETF. So we are looking at small caps. And this is a very, very messy chart, in my opinion, especially when you look at the weekly time frame. Not a nice thing to trade right now. So we had this range-bound movement largely between the 38.2 fib level at 188 and the 50% fib level at 170 for, just over a year now. Yes, there have been some breakouts and some breakdowns, but all in all, price is range-bound between these two key areas. More recently, though, after the banking turmoil hit, we saw a very strong decline, breaking below the 38.2 fib, all the way down to the 170, 50% fib level. And since then, prices really struggled to break above 180. And even last week, we did see a bit of a retest of 180, immediate rejection. So that's very bearish price action with that candle. And we are seeing that move lower. Now, the good news is 170 is acting as a very strong area of support. So I do expect price to actually remain above this level. But the bad news is that it is still underperforming the S&P and the NASDAQ. So small caps are still, that underperformance does seem to be continuing. And they're not the right place to be at, in my opinion. We are seeing momentum turn negative once again after going positive for a few days. So still, despite all the optimism around equities, or general optimism, I should say, we're still not seeing that that being reflected with the price action here for the Russell 2000. Okay, taking a look here at TLT. So last week I highlighted the 100 level as a key area of support. We did see support shift initially a little bit higher towards 104, but we did see a very recent breakdown below that, and price managed to decline to 100. And this is where I did mention to look out for some bullish price action. We could see a nice risk to reward bullish entry point. And we actually happened to get that as soon as price reached 100. We did see a very bullish candle, and it has been continuing higher. Now, overall, my bias is still quite bearish. I don't know. I wouldn't even expect it to reach 108. 108 would be the max level that I could see TLT rallying to in the next few weeks, if it even gets there. But overall, the reason I said that I'm not really looking for bullish opportunities is because I'd much rather look for bearish ones and selling into rallies, because overall, the trend is still a little bit neutral to bearish. If we do get a rally to 108, that would be great because it provides a nice risk to reward bearish entry point. But already price is under pressure. It's looking like it's failing at the retest of 104, set to open a little bit lower this morning. So we'll take a look at how price action reacts over the next few days. But for now, 100 is holding firm as support. I wouldn't necessarily use it as a thesis for long entry points. I'd much rather wait for a rally and sell into that rally for TLT. Okay, taking a look at the US dollar. So the US dollar has performed very well over the last few weeks, no doubt about that. We can see momentum has shot up to a near overbought condition, price breaking above its 21 and 55-day exponential moving averages, and all this after reacting to the 101 area of support on the daily time frame. Now, the next key level of resistance is at 105.50, and price does look so far like it's on its way there, but over the last few days, we are seeing rejections of that area just below 105. We saw it 2 sessions ago, yesterday, and even this morning so far, we're seeing a bit of a rejection there. And that could really, that's more due to the fact that price or markets are waiting on non-farm payrolls on Friday, because that's going to be a huge indicator as to what the Fed does with interest rates, and that has a huge impact on the US dollar. So we are seeing markets wait on that news, hence the consolidation so far this week. But overall, price action remains bullish. My bias is very limitedly bullish. I do expect price to reach the 105.50 level, but very much contingent on what happens with non-farm payrolls. If we do see a decline after Friday, we could see a revisit back towards the 102, 101 area, and that will act once again as a major area of support. But next key area to the upside is 105.50, and even if it breaks above that, you have 107.50 as well. Okay, taking a look at gold using the GLD ETF. Now, price action in gold has deteriorated to the downside after what has been a month-long consolidation period just below that 190 area. 192 has been my longer-term price target. Price did just about get there, or not quite. I was hoping for a slightly more juice in this rally for it to reach 192, 193, and then form a huge triple top on the weekly time frame, which would have provided the perfect entry point for a move lower. We didn't quite get that, but we are still seeing, despite price not reaching that level and rejecting the 190s, we are seeing now the bearish price action. So on the daily time frame, very messy chart if you take a look at it from a few weeks ago, but you can draw some support just below 185, around 184 or so. More recently, price did break below that, came back to retest it, failed, coming back to retest it again. It did reject it yesterday, but set to open a little bit higher this morning. That also has to do with the dollar weakness, because gold is inversely correlated to the US dollar. So when the dollar moves lower, gold will move higher, and when dollar moves higher, gold moves lower. Right now, due to the consolidation with the US dollar, we are seeing some bullish price action with gold, but again, very much contingent on what happens on Friday. The risk reward, in my opinion, or the trade to look out for gold, would be potentially a short-term rally over the next couple of days towards 184, 185, and from there a shorting opportunity if the dollar actually does manage to strengthen after Friday. Next key area of support is at 177, and you have another major area of support at around 170 as well. So that would be a pretty large downside target for gold. Okay, taking a look at oil. So, again, we had a long period of consolidation, a very frustrating period of consolidation, because it was at this key area between 72.50 and 70, which was an area of support, but also potentially support turning resistance. And price action wasn't giving any clues as to what would happen next. We were either looking for a breakout or a breakdown. We got a slight breakout, but immediately price reversed lower. And it actually managed to break below that $70 level, indicating that this is indeed a breakdown. So momentum very much negative, very much bearish, and I do expect price to continue lower. Even so far this morning, attempted to move higher, but rejected on an intraday level. And it does look like the bias is leaning more towards the bearish side, with 65 as the next major area of support for oil. Okay, so taking a look at sector rotation, we have 4 sectors in the improving and leading categories, and we have 7 in the lagging and weakening categories. So quite a big difference from the last time we spoke. Now, in the leading category, it's pretty much the same, the same sectors that are in there with discretionary, actually finding some relative strength. It was moving lower, turning more towards a sideways movement. And we also have communications and technology little bit difficult to read there. But both of these sectors have been providing leadership for quite some time, but are now losing out on some relative momentum. Still nothing too much to worry about, in my opinion. I still think that there's still a lot of rotation going into these sectors, given the risk on sentiment that we're currently experiencing by this AI boom. Nothing in the weakening category. Lagging category, on the other hand, we are seeing some rotation towards the upside for a lot of the underperforming sectors. So energy surprisingly moving higher despite oil actually moving a little bit lower. Let's see how this plays out over the next couple of weeks. But we also have financials after a long period of underperformance from the banking turmoil, finally starting to gain some momentum and dragging real estate along with that. We have materials and industrials as well, showing some signs of upside momentum, but nothing too much to talk about there. In the improving category, and as well, the new entrants into the lagging category are utilities and staples. So these are 2 out of our 3 safe defensive sectors, I should say. And we highlighted the fact that they were losing momentum, losing relative strength, especially with investors rotating from these defensive sectors into more risk-on sectors like discretionary, like communications, and like technology. So that rotation out of the improving category and into the lagging category for utilities and staples. And healthcare, even though it's in the improving category currently, it does look like it will be following suit. We are seeing this the healthcare sector lose out on some momentum and very close to rotating into the lagging category. So defensive sectors on the back foot, and we have more of a risk on sentiment as shown with discretionary and technology and communications as well. All right, so taking a look at some subsectors of interest that I have for you today, and it's really the ones that we've spoken about for the last couple of weeks, so a bit of an update on them. So we have TAN, the solar ETF, which we had a bullish thesis on when price was at around where it currently is. We were looking for a play on a bounce on the support level, which we initially got, but price was struggling to break above 74, or its 55-day exponential moving average, which is the blue line, and has been moving a little bit lower, but not really with a lot of bearish momentum. I mean, you can see price has found some support at around 70, struggling to actually close below 70, and set to open a little bit higher this morning. So, from a technical perspective, the bullish thesis is still very much intact, that price is able to stay above the $70 key level. However, from a trading perspective, if you had opened this trade a few weeks ago and the fact that it's actually not moving that much higher, you may want to consider closing it and kind of at a near break-even price. We're not seeing that bullish momentum that we want to see from this subsector, and we're not seeing it break above its 21 and 55-day exponential moving averages as well. So that is a concern. And if I had this trade open for a couple of weeks, I'd probably consider closing it for break-even. But moving on to DRIV, which was the Global Autonomous and Electric Vehicle ETF. Again, another bullish play with the 21-22 area acting as a major support level. We have seen price break above its 21 and 55-day exponential moving average and continuing higher with some very good momentum, running into some resistance along the way, at 24, at 22.50. However, not really showing signs for a reversal. Higher lows on a lower time frame are still forming. So bullish thesis very much intact. So far, this is a trade idea that is very much going in our favor. And our upside target for this one is still 25. So DRIV will continue to keep an eye on it, but so far, so good. And moving on to some market observations from last week, we have Moderna. So Moderna was a bullish play, and it actually performed very well last week, Tuesday, with price rallying all the way from the 127 area to 140. Since then, it has pulled back to 127, but maintaining a bullish, or I should say maintaining the bullish thesis of staying above 120. That is a major support level that I am looking at the weekly time frame. And price, even on an intraday basis, is managing to bounce higher from that area. So Moderna performing still not, I won't say it's outperforming, performing very well as a trade yet, but maybe a bit of patience is required because our bullish thesis very much remains intact and the risk reward is clearly to the upside. Next key area is at 160. You have 140, 160 as well, and you also have the high 170s, low 180s as a third target if you really want that. But I'd be more focused on 140 and 160 as the two upside targets in the short term. Moving on to Fidelity. So Fidelity finally showing signs of, going according to our plan. This was a bearish trade that we've had for the last few weeks. It was bearish because of this long-term bearish trend line defined by lower highs, lower lows, and previous areas of support turning out to be resistance. That happened quite recently at $60. We saw that previous area of support turning resistance after this breakdown, and price was flirting with an area for quite some time. More recently, though, we did see it move lower and is at around 55 or so. So this is a trade, again, a bit of patience was required, but the trend is still quite bearish. And it speaks to the fact that this is a weak stock currently, especially given time that the S&P and the Nasdaq are moving higher. Fidelity is actually moving lower. So I do expect this to continue lower. First target is at around 48, but price could make a new lower low on the weekly time frame as well. Okay, taking a look at CrowdStrike, which was a bullish play from last week, and a little bit unlucky here on CrowdStrike. It's still technically speaking a break even from when I last spoke about it, when price was at around 143. We had a rally to 160, so it was a very good idea in the fact that it was an immediate rally, right, from 143 to around 160 in a matter of a few days. But we had earnings, which saw price move back down to 143 pre-market the last time I checked. So pretty much erasing our gains. But if this was a trade that you did take, and if you did see that earnings were, yesterday or last night, and you took profits before the close yesterday, then well done, because it was a trade that worked very much in our favor. However, if you did not, I think the best thing to do is probably get out of the trade. It is back at break even, and it's getting out of the trade after a bad earnings announcement at break even isn't necessarily a bad outcome. So CrowdStrike, unfortunate earnings announcement, but not necessarily that much of a bad outcome. Okay, and finally, we have Lowe's. So Lowe's was a bearish play from last week when price did gap down a little bit, and then it managed to recover. But overall, price action is still quite bearish. Price definitely under pressure at 208 resistance, and it's also range bound between 208 and 185 major supports. The more relevant support level, I would say, is at around 195, 196, as you can see on the daily time frame. So that would be a downside target for Lowe's. Very much a short-term play then. Momentum is also declining, so it does indicate that Lowe's could continue to move lower, along with opening lower this morning. So overall, this trade still working in our favor. And with that, that is all I have for you today. Thank you so much for joining me. And I will see you all next week, Tuesday, for another market outlook. Hope you all have a great trading day and a great weekend, everyone. Goodbye.